They've already tightened. You're going to get a slowdown or a downturn, and you're probably going to see inflation trending down. And so if you're in the central bank's shoes, you are inclined to shift. And so you're inclined to sort of take the foot off the brake a little bit because you think you've probably done enough. The fact that they pause and the markets rally actually also supports growth. And so you end up, the inflation rate doesn't actually settle out at the target level. So now we need to go in and make another round of tightening.
I think they've already over tightened, and I think they're likely to over tighten by a lot. And that it's just the lead lag thing, and a pause, while it can have that effect in markets, for part of the reason Bob's saying. I think the thing everybody's missing is just how much they've tightened by any historic measure, how that impact is still flowing through. It's just beginning to flow through, and you see it with the tech companies and stuff. This stuff is going to start taking on that spiral line.
I'm Jim Haskell, editor of the Bridgewater Daily Observations. One of the biggest questions for investors right now is how the current tightening cycle is likely to play out, even after all of these interest rate hikes. In yesterday's observations, Co-CIO Bob Prince shared his thoughts on how much tightening is likely to be required to bring down inflation and how we can know whether the Fed has tightened enough. That question of how the tightening will progress was at the core of this week's research meeting. And in that meeting, there was a good exchange of views between Bob and Co-CIO Greg Jensen on how they expect the tightening to develop. And we wanted to bring you some of those clips in this installment of our Inside the Research Engine podcast series. To do that, I bring in my colleague, Jake Davidson. And Jake, you and I were in that meeting. What were the key aspects of this back and forth?
Thanks, Jim. I think the really interesting thing about that discussion was that Bob and Greg agree that the Fed needs to engineer significant weakness in demand in order to bring inflation down, and that this is likely to be very bearish for equity markets, especially considering what's currently priced. But they disagree somewhat on how the Fed is likely to approach getting to that point. Bob sees the Fed as potentially likely to take its foot off the gas a little early and need to restart the tightening cycle when it becomes clear that demand hasn't fallen enough to really kill inflation. Well, Greg thinks the Fed is actually at serious risk of over-tightening and creating a severe recession.
Now, to be clear for our listeners, we don't actually manage money based on these sorts of outlooks. What we do is identify the key cause and effect linkages that we believe are timeless and universal, and then measure those linkages on a continuous basis with the goal of having an optimal response to known conditions. But still, the path of the tightening does matter for markets, and we think this is a helpful discussion for our research teams and therefore also for our listeners, and that's why we're sharing it here.
So in this first clip, you'll hear Bob lay out how he sees the cycle progressing and how he thinks the Fed is likely to potentially back off too early, not do enough to kill demand, not do enough to kill inflation, and end up in a position where it needs to do multiple tightenings. Let's listen.
Yeah, so it starts with, what are the causes of the inflation? And what does it mean when you're in a stagflation? And the cause of the inflation is too much money chasing a given amount of output, and hence the need for tightening. But tightening, to the extent it causes economic weakness in a downturn, may or may not be enough to bring the inflation rate down. But as I play it out, I think where we end up is that they've already tightened. You're going to get a slowdown or a downturn. And as that's happening, you're probably going to see inflation trending down. And so if you're in the central bank's shoes and they're balancing, one goal not being achieved against the other goal not being achieved, you are inclined to shift. And so you're inclined to sort of take the foot off the brake a little bit because you think you've probably done enough and the inflation rate's trending down. And maybe even stimulate a little bit, or maybe not. But even if you don't stimulate, the markets at that point have discounted, are down a lot, right? And so it might be their oversold conditions or whatever. And so the pause in the tightening will tend to cause a rally in the asset markets. And the rally in the asset markets will then tend to support the economy. And so if the central bank was thinking that, okay, my work on inflation is done and it's going to keep trending lower to 2%, the fact that they pause and the markets rally actually also supports growth. And so what ends up happening is that you end up getting better growth at that point. better asset markets, better growth. And that sort of preempts, even if the inflation rate was going to be trending down to the target level, that pickup in the markets and the pickup in the economies works to preempt that subsequent decline in inflation. And so you end up, the inflation rate doesn't actually settle out at the target level. It may, if we put a number on it, maybe it settles out at 4, 3.5 or 4 or something like that. And so then what happens now, the central bank is faced with, okay, well, we thought we were going to be at 2. Now we're at 4. Economy is doing fine again. At least it's positive growth. Asset markets have recovered to some extent. And so now we need to do it again. So now we need to go in and make another round of tightening, another round of interest rate increases to essentially repeat the process and until we bring that inflation rate down to 2%. The alternative would be to accept the higher inflation rate, and they might do that. That's how I play it out. And so you end up going kind of back and forth between, I'm going to, tighten to bring inflation down because I've got enough growth, and since I can't achieve both goals at the same time, I have to choose. And if I think that the growth is fine, I'll tighten to bring inflation down. But if I think I've done enough, and you keep in mind that policy choices are made based on where they think things will be in a year, right? And so if they're extrapolating out the improvement in the inflation rate as a reason to sort of take the foot off the brake, then they're likely to be wrong with that extrapolation as they go back and forth between tightening to bring inflation down, easing to support the economy, then go back the other way. And so maybe it's 2 or 3 rounds of that.
So that's Bob's view on how the Fed might end up going back and forth in terms of easing and then tightening. Now, in the next clip, he goes into a little more detail around the lag time between central bank actions and the flow through to economic conditions, and why this lag makes it easier for central banks to accidentally under tighten.
I think the normal lags will apply. So if you have the tightening of monetary policy to affect the economy, it's typically 12 months, something like that. And we're 8 months or something like that in. And so we should be seeing it, pretty soon. So we would see economic weakness, fourth quarter this year, first quarter next year. The other lead time is between the weakness in income. So now as you've reduced spending and you've reduced income, but you've reduced income mostly by a credit contraction. So if you think about income, household income is the growth in the people working plus the wages. And so maybe you've brought income growth down to 4%, but it's like a negative 1% from employment contraction and a positive 5% from wages or something like that. So when we look at the lead times of an income contraction or a spending contraction, they go together, to wages, it's like 18 months. See, this is part of the why you have to do it twice, because if you have a monetary inflation or I describe it as a monetary induced inflation. It started with money, but now it's the recirculation of income and spending that has now passed through to affect wages. Then you actually have to tighten long enough and keep the economy weak for long enough that you have the effect on wages coming back down. And we're starting from 5-6% wage growth. And so that's an 18-month time frame to do that, right? Roughly. So it's very easy for them to oscillate back and forth, because if they see the downturn and they extrapolate the improvement in inflation and they take the foot off the brake after, too early, well, you haven't gone 18 months of a rise in the unemployment rate to re-equilibrate employment markets and bring the price of labor down. So you got one lead time is the tightening to the growth, not just to spending, but also to a contraction in employment. And then you got the lead time from the contraction in employment and a headcount or payroll basis to the cumulative effects of that on the unemployment rate, which is required to rebalance the pricing of labor and bring the wages down. So they're likely to get that wrong. They're not likely to stay tight long enough and tolerate weak growth for long enough. And therefore, they're not, in the first round of tightening, they're not likely to do enough to bring wages down. And then, so you got to do it again.
One follow-up question some of our investors had for Bob in this research meeting was whether the strength of the labor market and consumer spending might make the economy more resilient to a tightening. And so in this next clip, Bob shares his thoughts on that question and what it would mean for the central bank reaction function if the economy does remain very resilient to further rate hikes.
Where it does make sense to me that the economy is probably more resilient to the tightening than it has been recently. And that's consistent with the things we've been talking about in the last year or so, where balance sheets are a lot better, bank balance sheets are better, the flow of credit can be sustained, interest rates are low in relation to nominal growth and all that stuff. And that basic idea of the reversal of the past decade of the financial markets outperforming the real economy, reversing where the economy is outperforming the financial markets, that's all, I think, consistent. But if that happens, that just means that the pricing of labor just is more entrenched. The wage inflation is more entrenched, and so the question on the wages and the freezes is a matter of just degree. So the question is, if you're just working through the pricing attribution of labor, just like we do a pricing attribution of stocks and bonds, have the dollars of demand shrunk enough relative to the quantity supplied to reset that price level to a 2% equivalent to a 2% inflation rate. The scenario you're describing for the economy makes that a lot less likely, and makes the scenario where we settle out. That scenario basically is the scenario you described is more like a no pause scenario. Steadily rising rates over time, and no pause and no rally in the markets type scenario. And then in terms of where the short rate settles out, it depends on how they do it. The harder they hit it now, the probably the lower the peak, and how they change the composition of QT and the interest rates also matters, right? So if they were to reduce QT, then they have to do more interest rate increases. So those two things are really working in concert together to provide the total amount of tightening.
Now we move from Bob to Greg. And in this next clip, you'll hear Greg's thoughts on how the cycle is likely to go and why he thinks the Federal Reserve is likely to keep tightening and even over tighten until there is a significant recession underway. Let's listen.
Yeah. So I think the usage of fiscal policy has changed the game. And I believe we're in that for the ongoing future, but maybe wrong. I don't think they get these turnarounds that cause inflation unless they're use the fiscal policy lever. That once this economy starts going down, it's going to be very hard to stop it. And I don't think it's going to take a tremendous amount of easing to stop the slowdown for the same reason it's taking a tremendous amount of tightening, I think. Because I think everybody's mortgages are set at 3%. Like, you got to get mortgage rates back down to lows. The fact that a pause will not be bullish for the economy. I think they've already over tightened, and I think they're likely to over tighten by a lot. And that it's just the lead lag thing, and a pause, while it could have that effect in markets, for part of the reason Bob's saying, I think the thing everybody's missing is just how incredibly, how much they've tightened by any historic measure, how that impact is still flowing through. It's just beginning to flow through, and you see it with the tech companies and stuff. This stuff is going to start taking on that spiral. I believe the savings rates are incredibly low for an economy where rates have risen and assets are down. And the only reason I think that could plausibly true is people are spending the money that they printed. And I agree with Bob on that part was monetary, but the money's coming out. The need for cash is rising. The high interest rate means more money will sit in cash, much more money than it has for a long time. And talking about even a moderate pause, which they're not even that close to, they're going to raise 50 and whatever. Like, they're not likely to pause anytime soon. So I believe the bigger thing is going to be, it's going to be a crack, and a very hard to stimulate crack, and that the crack is actually going to be quite large. I want to go through this. I don't see the balance sheets as nearly as healthy as I think others are. Yes, they're healthier than they were in 2008, but they were incredibly unhealthy. And when you look at it globally, wow, there's a lot of danger out there. Just going to Canada or whatever, the Canadian housing market, the UK, like the UK housing market, like all of these short rate driven markets. And I think will end up being true of a lot of the short-term stuff in private debt markets that are short-term, that all of a sudden you were paying zero interest and now you're paying 4 or 5, 6% interest rates. Like I think these are big shocks that still feel to me like that we're only starting to see this ripple, and that looking backward at the employment report or whatever is, to my mind, always very late. And I remember these conversations in 2001 kind of things that S&P held up, held up more than it is now even, but held up. And, but the things were cracking in the background. That's certainly what it feels like to me. So we'll see. Do you have one of these like minor recessions that the markets can look through that if you take, I think is like the forgotten recessions point of post-World War II recessions up until the financial crisis were generally pretty modest. And it is interesting that the top in inflation was often the bottom in markets. And so I am a little worried about that. I don't think so. I think this growth slowdown is more extreme. I think the debt levels around the world are at levels you never had anything like this amount of global debt other than 2008. And you have a tightening that's way beyond anything that we've been through for a very long time. So my guess is when the economy starts slowing, it's going to be super hard to stimulate. But they know the tool, it's fiscal. In the US, of course, part of what's going to happen with the elections is that you're not getting fiscal for 2 years, I think, almost certainly. So if you have a downturn, you don't have a fiscal level. And I think the Fed, because of inflation, is lagging so much. They're going to lag the real economy on purpose because they're dealing with the question Bob's saying. They don't want to ease too soon, which is a totally different type of easing than they've had over the last 30 years, where they always eased when assets went down. And so this is, I think, hugely dangerous, and that they're not going to ease, that they're going to keep looking at inflation, and they're not going to ease even as the slowdown begins to become entrenched. They actually want that. So maybe like the question of did they over tighten or are they actually going to let off the gas is so hard. It's so hard to know because the lag is so big. But anyway, my thought, and I think you're seeing it in the tech sector or whatever, and I think that's a huge sector, and then it's going to flow through other things, that the weakness will start, and the weakness will be hard to stop through monetary easing, because you have to get interest rates so low to I think, to re-stimulate, because so much of the debt is set at interest rates much lower than today. So those are quick thoughts. But the thing that I agree on is the world is more inflationary. Deglobalization is a hugely inflationary thing. Companies are going to have to spend money during this recession in a way they normally don't, because they have to change the supply chains. You look at what Apple has to do. You look at what everybody's got to do. They got to change these supply chains. And that's a hugely expensive mission in the middle of a downturn. And in some ways, that forced spending helps to offset the downturn, because it's forced spending during a downturn. Usually that doesn't happen. But it's extremely bad, I think, for profit. So my guess is the profit picture is going to be a lot worse, that we're on the very early phase of it.
In addition to sharing his view on the tightening cycle more broadly, Greg also addressed why he thinks consumer spending, which is, as Bob discussed, has really held up so far and has been quite resilient, is actually on the precipice of weakening.
I think that, my view on this is probably we have the biggest divergence I've ever seen or ever even considered on the difference between what we think drives the savings rate and what's happening with the savings rate. And now I do think that the reason is people got a lot of cash. This is how like kind of the monetary inflation sticks, is they got an improvement in their balance sheet. They're still spending their way through it. But the incredible degree, and then as a result of that, in a sense, the employment stays strong. So they don't need to cut their savings rate, and they usually raise their savings rate as the economy starts to apparently slow down and they start getting worried. You take the move in assets, the move in interest rates, like savings rates should be, and typically would be, way higher than they are. You add in the demographics and stuff, and that people are losing their savings for retirement. I think we have this extremely lagged movement in the savings rate that is lagged for reasons we know, that essentially you got this fiscal pump and it's working its way through. As soon as people start, and it is happening, people are getting laid off. As soon as people start getting laid off, the savings rate rises. That leads to more people getting laid off. And that's the self-entrenchment. And I think with interest rates where they are, with asset prices where they are, all of a sudden people thinking, holy cow, where's my cushion? I don't have much cushion. And that's that's the cycle that I could be wrong, but the cycle, I think we're right on the tipping point. And I have made this point before, but I think it's as like, to me, the mechanics of that are pretty darn universal. And it'd be a interesting surprise if you somehow avoid a savings rate increase self-reinforcing as the employment situation weakens. And we're seeing it, like, I mean, the tech layoffs this month, the layoffs are big and they're coming fast. So I think you're gonna start to see that. Now, it's interesting that the place you're getting layoffs are kind of the least labor intensive areas at this point. But between what's happening in housing and what's happening in tech, I think you start that cycle quickly. And it'll be interesting to see if tech people can start getting jobs in other sectors or something like. But that'll be the question.
So that was Greg giving his view. And now what our listeners will hear is Bob coming in and synthesizing the key similarities and differences between that view and his own. Let's take a listen.
So if you overlay what you and I just said, you've got the first, second, and third order, events, right? And at the first order events, you're basically saying there has been enough tightening and then there will be enough tightening that's going to cause a significant downturn. And that downturn is likely to have self-reinforcing characteristics. And specifically, it's going to be a contraction in labor markets and a contraction in earnings. And so what I'm saying is very similar, just in the opposite order, which is I'm saying that the Fed is going to have to continue to tighten until they get a contraction in earnings, which necessitates a contraction in labor markets. So either way, you're going to have to get a contraction in labor markets and go into something like, a slowdown in the growth of non-farm payroll is neither enough nor the likely scenario. So that's the first thing. And so we're just saying the same thing from two different directions. Then the next, where we're diverging there is in the second order, which is you're basically saying that downturn is likely to be self-reinforcing and very hard to get out of. And it'll probably require fiscal stimulation to do it. And it's going to take a really serious decline to get everybody to agree to do that. What I was describing was a different scenario where the Fed is a little quicker to take their foot off the brakes, that there's not the self-reinforcing process. They sort of chicken out sooner, that they extrapolate that they basically see the good news of the decline in inflation and extrapolate that and take the foot off the brake a little earlier, and that you don't ever hit the self-reinforcing decline. So that was the difference in what you and I were talking about. So who knows? That's the second order, and we'll see. And then depending on which one of those it is, right, the third order follows from that. And so, that would be how I would overlay what you and I are both saying. Just so there's not confusion, while I'm saying there might be a bounce if there's a pause, I think that the thing that's not discounted is in the equity market is the substantial decline in earnings. Whether that happens next or whether it happens after that, or what, one way or another, you're going to have to get, it's almost like the Fed has to target a decline in earnings because they have to get a contraction in the employment in order to bring wage inflation down. And so one way or another, you're going to have to get a decline in earnings, and that's not discounted in the equity market. And you're going to have to get a contraction in the labor market to drive the unemployment rate up, just to be clear on that point.
I think we'll leave it there. A very important topic, which we're sure to continue to monitor and comment on. Jake, thanks so much for joining me.
Thanks, Jim.